Hey folks, another episode of Business Foundations. I'm really happy to be here with you today. And today we're going to talk about asset-based loans. Last time we talked a little bit about bank lines of credit. Now we're going to be talking about asset-based loans. Now, on the surface, asset-based loans sounds a little bit like a bank line of credit, but there are some structural elements that are a little bit different and some reporting requirements that are a little bit different. Now, asset-based loans are based on your receivables. So we talked a little bit about a bank loan. Now, bank loan does use receivables as collateral and has a borrowing base tied to it in a lot of circumstances. But asset-based loans take a much more granular view of your accounts receivable. Number two, another source of assets that they lend against is inventory, and we'll get into that in a little bit. And in some other rare circumstances outside of true traditional equipment lending, some asset-based loans will take into account equipment. Bank loans really are based on sort of covenants and sort of the relationship you have with that bank. Asset-based loans are a little bit different. Now, a lot of people would argue that all lending in some way, shape, or form is based on relationships, and sure, we can talk about that. But the reality is asset-based loans, the way they track them are much more formulaic than a traditional line of credit. So if you're a growing contractor, you need to really understand the differences and the levers that you can pull within bank loans or asset-based loans and how that informs how you want to grow, because each are similar, but there are very different nuances. So what problem or when should an asset-based loan truly be used? Number one, they should be used when growth is accelerating. So compared to a bank loan, asset-based lenders really take a little bit less into account profitability. A lot of asset-based loans are implemented in scenarios where the profitability of a company is relatively thin. It has much more focus on the asset quality of the company. So as your assets grow, your availability on your asset-based lending structure, which is going to be in a revolving structure typically, is going to grow with it. So your partner, your ABL partner, although I'm just going to use ABL going forward to make things easier, your ABL partner is going to grow with you as your asset base grows with you. Now, the quality of those assets is very important, and I can get into that sort of in a few minutes. But the reality is it takes a ton of operational discipline to engage in a relationship surrounded by growth with an asset-based lender. Your reporting requirements are pretty meaningful. For example, you're probably going to have to submit a borrowing base certificate. A borrowing base certificate is essentially telling your lender, what is my asset position at that point in time, and how does it relate to the rules governing my asset-based loan, like the advance rates, the asset quality, the collateral quality, for example. Asset-based loans are a little bit less covenant specific, and I kind of identified that a few minutes ago. They're much more asset quality and as your asset base grows, the facility can grow with you. A bank line of credit's not really going to do that. Bank lines of credit are really governed by a system of covenants, and I've kind of reiterated that, but that's the key difference there. Also, a bank is really going to be looking at your profitability because they base in a ton of sensitivity analysis into sizing the proper loan and sizing your advance rates, and the list goes on. So let's talk about asset-based loans and how they sort of view certain asset classes. So obviously, the most liquid asset's cash. Now, any lender can probably lend against cash, but the reality is you're getting a loan in the form of an ABL because you need more cash to grow. So we're going to put that over to the side. The second most liquid asset in your portfolio outside of investments, if you have an investment portfolio, is accounts receivable, because you have completed the work, you have submitted an invoice, and your customer has promised to pay you for the work that you have done based on a predetermined set of terms. That could be 30 days, 60 days, 90 days, whatever that may be. Now, an ABL is going to look at those assets when I say assets, I mean accounts receivable for now. And they're going to advance a certain amount of capital to you for operations or to continue on and completing your jobs for direct costs. It can be really for anything that you want. They're going to assess that accounts receivable and say, okay, what portion of this accounts receivable is way past due? So let's just say you guys are familiar with AR or accounts receivable aging reports, right? Now you have the 90-day past due. Most ABLs are not going to count your 90 plus past due receivables as even eligible within the borrowing base, right? As you have current AR on that AR aging report, you have sort of 1 to 30 past due, you have 31 to 60 past due, 61 to 90 past due. Some ABL structures will discount some of those older receivables. They may not make them all ineligible, but in most cases, 91 plus is going to be completely ineligible. And in a lot of cases, almost every case, retainage would be ineligible as well. So let's say you have a $10 million worth of receivables. And let's do some quick and dirty math here, right? You have $10 million in receivables, and let's say you churn your receivables every 2 months, right? So that would imply you're doing what, 10 times 6, so you're doing relatively $60 million in revenue. You have $10 million in accounts receivable outstanding, right? So let's say $2 million of those receivables are 91 plus. Maybe that encompasses 2 jobs. Maybe you've done, maybe this was fiscal year 2025, you did 25 jobs, that $2 million encompassed 3 jobs, let's say. They would count that as ineligible. So now your starting point is $8 million for the advance. However, they also take a strong consideration to customer concentration. So if you have $10 million in receivables and $5 million of that is with one customer, they're probably going to consider a portion of that $5 million as ineligible to reduce their overexposure in advancing funds relative to one customer. So they might say, okay, we have a 20% concentration limit on whatever is outstanding in your receivables. They might even do what your revenue concentration is, but typically they would look at the AR aging report and analyze it from there. So they would haircut you $3 million right there for considering those accounts receivable in the borrowing base. When you look at inventory is a little bit more complicated. So the advance rate on whatever your eligible receivables are for accounts receivable is typically between 80 and 90%. Some more conservative ABLs might go 75%, but typically ABLs, non-bank ABLs, will go up to 90%. So when you submit $2 million worth of invoices, they will advance you $1.8 million for operations in your company, right? That's how that kind of works. It's a very liquid asset. That's why the advance rate's so high. Number 2 is inventory, and that's the second trading asset that companies will advance against. It's a little bit less liquid, right? You have to sell the product. You still haven't billed your customer yet, so it's a little bit further down in the business operation. They're going to advance between 50 and 70% of inventory, right? So 70% would be on the aggressive side, 50%, 45 to 50% would be a little bit more conservative. So let's call it 60%. However, they have ineligibles there too, right? And they might have different advance rates depending on where in the production process certain parts of that inventory are. There are really three types of inventory, excuse me. Number 1, raw materials, all the stuff you put into all the materials you put into assembling a product. Number 2 is work in progress, right? Those are the SKUs or the products that you're in process of building. And number 3 is finished product. Now, not all finished products, I'll go down this here, not all finished products are created equal. Finished products that are for a very, very niche application. So if you're a specialized manufacturer for a specific application that can't really be liquidated or resold other than the market that you're selling into, and the market that you're selling into is extremely small, they might consider that inventory a little less favorably than a finished product that is applicable to many more. Work in progress, I'd love to ask some of my ABL friends out there how they view work in progress, but traditionally ABLs are going to look at work in progress as it's work in progress. So how do you, if something goes wrong, how do you capture that and liquidate something that's not in its original form and not in its final form, right? So the value of that is probably not as high is definitely not as high as a finished product. And then raw materials. A lot of raw materials you can sell on the open market in the event of liquidation or in the event of default. So although the raw materials may not be as valuable as the finished products, they're still going to be looking at the raw materials as a collateralized trading asset, and they're going to provide an advance rate on that. So in sort of in summary on the advance rates, you have your aggregate number, your actual AR, your actual inventory. There's a process of discounting those with respect to getting out all the ineligibles that are not within the appetite of the ABL to consider within the borrowing base. And then you get to a final number where you then slap on, if it's AR, slap on a 90% advance rate on that, and that's your availability. Or inventory, they'll slap on, say, a 60% advance rate on the appropriate inventory, and that's how much availability you have. So I tried to kind of outline sort of the mechanics and the ins and outs of an ABL. Asset-based lending requires strong discipline, requires a lot of documentation, requires a lot of reporting, because as you can imagine, based on what I've talked about so far, an ABL is predicated on both the value and quality of your current asset position. So a few things, I'm just referring a little bit to my notes here. When does an ABL work really well? So it works really well for companies that are in a relatively predictable high growth situation. Margins might be a little bit small, so a bank is either not going to provide you the dry powder to grow, and they're a little bit squirrely about the thin margins to your bottom line. It's very helpful, like I said, when you have very thorough, consistent, and disciplined documentation. When you have a diversified general contractor base, or in a manufacturer's instance, when you have a diversified customer base, right? And when you have a little bit more sophisticated accounting systems, due to the fact that they're requiring you to document and report on a regular basis. But it is a really, really good tool if you want to grow and scale, and you have a strong grasp on your cash conversion cycle and the cash requirements in between certain components of the cash conversion cycle. So you do work, you invoice, or you get inventory into your warehouse, you get the amount of money that you need predicated by the rules and conditions of the borrowing base. You take that money and you fuel more growth for more jobs, right? But it is once you have invoiced, right? It is once you have had the inventory land on your site. So when does an ABL become dangerous? When AR quality declines, which means your ineligibles increase, which means your ability to borrow decreases, but that doesn't change the fact that you're still growing and that you still have costs that you need to pay for, and that you've built a fixed costs infrastructure like your overhead to support that growth. That's when it can get in a little bit of trouble. Aging stretches, I talked a little bit about that. Keep in mind, concentration limits don't typically, with really good ABLs, don't typically work well with ABLs, and I talked a little bit about that earlier. And you're already, if you're using an ABL, there could be a scenario where you have tight margins. Now, depending on what ABL facility you use or what partner you partner with, you need to make sure that margins are staying relatively consistent. So if margins deteriorate on bad jobs, that interest expense and those financing costs on that ABL are going to eat into that profit. And that puts you in a position where the economics of what you're doing just don't really make as much sense. So guys, ABL is super useful, growth oriented, understand your asset base, understand how to deliver information and speak in a clear, coherent way to your lender so that they feel that they're in it with you, and you can absolutely use an ABL to scale. Thanks again. This has been Business Foundations with me, and I'm really happy you're here. So this is me signing off.